Welcome to the Keep Yours podcast, where we'll help you decode the complex financial system so you can better understand how to thrive within it. This is where you'll learn strategies and life hacks to stay out of debt, claim your financial power, and keep what's yours. Here's your host, David Bradshaw.
Citizens of the world, welcome back to another podcast, Keep Yours, where we try and keep you out of debt and capitalism. We're going to continue our theme of compounding interest and learning about money and money terms. Congratulations on making it this far. You've already probably learned more terms than most people in America know and understand, and hopefully you're actually gaining a good understanding of it. So I wanted to go over a brief recap of what we've talked about so far in a couple of podcasts here. We've talked about capitalism. We've talked about how we've been programmed and that we haven't been programmed to understand these things correctly, that the education system isn't giving us what we really need to thrive in this world of capitalism, and probably intentionally not giving us the education because for the most part, the capitalists want to remain the capitalists, and they like that people don't know about money. They like that people are ignorant to what compounding interest really means when it's working against them. And they don't want people looking at things in a more critical area. So it's important, if you want to stay out of that system, and if you want to thrive in capitalism, at the end of the day, you need to be the capitalist, not the one the capitalist is lending money to. So we talked about currency and the history of money, and we've talked a little bit about exchange rates and how currency can differ and how the value of assets can differ across countries in the context of inflation and how there's basically monetary inflation. So, and we want to keep it there. I don't want to get too in depth about intercurrency exchange rates and how all that really matters and affects everybody. Because for the most part it doesn't. So we want to keep things simple. So what we really focused on last time was interest and what interest is. Interest is the price of time on money. And we went into the factors that go into that interest rate that you're going to pay. And the main factors being inflation, the risk of the asset that you're buying, or if there's not an asset, then it's considered an unsecured loan, so you have a higher rate, versus a secure loan has something they can come and take. And then your personal risk based off of your personal history of repayment, i.e. what they eventually end up with is your credit score, and that's what that number is mostly based on. So that's what comprises the interest rate. So we also talked about what that asset risk is and if that's collateral. Right? If there's a car or a house you're buying, then there's collateral for that loan, and that makes it a much easier loan for the bank to give you, and it gives them something to go take if you don't repay. So today we're going to focus more on compounding interest. Now this is a often thrown around term, and the reason that most of us have heard of this is they like to throw it around when they're talking about our retirement planning. And how we need to save, and the power of compounding interest when it's working for you. And compounding interest as a concept is as simple as this. If I loan you money for a long period of time, or you're investing over a long period of time, it works either way, one way for you, one way against you. If you're borrowing money, and let's say you've got a 10% interest rate. So I loan you $1,000 at 10%. At the end of a year, you owe me $100. So either you can give me that $100, and then I'm going to reinvest it in something else, loan that money to somebody else. Then each time I get my $100 from you, I re-loan it to somebody else. Then next year, I'm going to get interest on the payment that you've already given me. Now, when it's working against you, that means that if I loaned you that $1,000, and at the end of the year you were supposed to pay me $100, and either you paid it to me and then needed to borrow it again, but now instead of you owing me $1,000, you owe me $1,100. So next year, if it's the same 10% interest rate, you're not going to owe me another $100. You're going to owe me the $100 on the first $1,000 I lent you and $10 on that $100 I lent you. So now the loan amounts increased from $1,000 to $1,100, and my interest payments increased from $100 to $110. So if you're investing, the way that this works for you is you take that $1,000 and you invested it. And 1 year later, it's not $1,000. It's now $1,100 because you made 10% on your money. 10% would be a good amount to make. And that's, I'm going to say, the objective amount for the most part. That's what we want to make on our money. If we get 10%, most people making 10% right now, pretty happy. Pretty happy with 10%. But let's just say you can make 10%. So that first $100, year one, you have we're using $1,000. That first $1,000 at a 10% rate. Year one becomes $100 of interest. So now that becomes $1,100. Then you get 10%. On the $1,100, it becomes $110. So at the end of year two, you've got $1,210. Then you get interest on the $1,210, $121. And that $121 adds in, and now you have $1,331. Year four, you get another 10%, another $133. So now you're going to have $1,464. And at year five, you're going to get another $146. And I'm showing all of this to you on a worksheet here. So if you go to our blog site, you can pull down this worksheet and it will show you exactly how this math works. But basically, in simple terms, if you take $1,000 and you invest it at a 10% rate, where it can stay invested and you're basically reinvesting that interest payment every year, at the end of 5 years, you've got $1,610. So you've made $610 on your original $1,000. By 7 years at this 10% rate, you will literally have doubled your money. That's the power of compounding interest. Here's the other side of that. What if you're the person that owes? So if you're the capitalist and you're collecting 10%, your money doubles every 7 years. It's the rule of 7. And the rule only works if you get 10% interest. But, and getting 10% interest isn't as easy as it sounds. Paying 10% interest is very easy. In fact, almost no credit cards start at an interest rate below 10%. So if you do the reverse, and you're the one paying, well, if I'm the capitalist and I loaned you $1,000, and I continue to loan out that money to you and others, so let's just say you're paying me back, but all the money you pay me back, I just loan to somebody else, and I continually can get this 10%. So at the end of 7 years, I've basically doubled my money. Well, if I've doubled my money, where'd it come from? It means all the people that I've loaned money to are paying me. So that means all the people that have had the money loaned to them are paying double over 7 years when they're paying interest. So interest can work for you or against you. And compounding interest, the simple idea is it's money on money. So when we get down the road, I have a program that I'm going to design out. But the simplicity of it is this. let's just assume we make 5%. Okay? That's a much more reasonable number we can get to. 5%'s available, I'm going to say. So if you can make 5% on your money, if you can put away $100, then every year you're going to get $5 from that 100. And there's a program I'm going to call Get Fives. So your whole plan is to get away $100. Get that set aside so you can get 5 off of it. And then get another $100 and get another 5 from that. And get another $100 and get another 5 from that. And if each month you put away $100, then each month, each $100 is making you $5. And then you take those $5, pretty soon, they create their own hundreds. This is the power of compounding interest. And it plays out really well if you actually just do it. If you sit down with Monopoly money and just do it and look at the worksheets and you go, oh, wow, that's money I could be getting. So capitalism is one of two ways. Either you're the person paying or you're the person receiving. You can sit out neutral. You can take your money and just put it under a mattress. And we'll get into what people buy with money. So we've gone through the history of money. And we've talked about currency, and we've talked about inflation, and we've talked about what an interest rate is and what interest is, the cost of time on money. So compounding interest is then the receipt, either the receipt or price of time on money on money. So you take your $100 and you invest it and make $5. If you leave that $5 invested, that $5 the next year makes 25 cents. Which doesn't sound like a lot, but 25 cents is making, it's money that's effectively free to you. All you have to do is get your first $100. Get your first $100 invested and make 5%, and then you have $5, and then the $5 makes its own money. And then the $5 after that makes its own money, and the quarter that you get from the $5 makes its own money. And the idea is that once you've got enough money away and working, there's a revenue stream for you of constantly produced money from your savings. But if you never save, i.e. you never become the capitalist, then you never participate in this. And most people's participation is from the other side, compounding interest working against you. And the reason this is an important concept to understand is this is how they keep you stuck in the system. This is how they suck all the money out of you. Because if you think the system is set up such that they're only going to loan you a certain amount of student loans that you could effectively pay back, and they're pretty certain about this, you're wrong. And if you think they'll only give you enough credit card debt so that you could always make the payment with the amount of money you're making, you're wrong. In every single circumstance, they're going to loan you just enough money so that you owe more than you make. So in a rational capitalistic society, there would be limits on the amount of credit somebody could obtain based on the amount of money they make, based on the rest of their expenses. Now, the credit card and bank companies will tell you, well, we don't have all of the information of exactly what everybody makes. Bullshit. They buy it. They're very interested in buying it. They want to know exactly how much money you make. They want to know everything that's on your tax return. And them pleading ignorance is nonsense. They know better. They know that collectively they're all issuing more credit than anyone should ever have. That if people used all the credit that was available to them, unless they used it to buy assets that were creating more value, And even in that case, with the higher interest rates, there's basically no way that people can pay this back. And this is what happens to people slowly over time who don't understand compounding interest. And let me give you a very clear, easy example. Oftentimes what we're paying for is convenience. Convenience and satisfying a current need today. Okay? Convenience is basically the price that you're willing to pay to get something immediately versus getting it a little bit later. And we know convenience sells and sells well and is very, very prevalent because it's everywhere. There aren't convenience stores for no reason. What are convenience stores doing? They're charging you more sums of money for the same products that you could buy elsewhere for a lot less. Now, for the store to actually exist, it has to pay rent. So a 7-Eleven, an AM PM, those only exist because people are willing to pay a premium, and often a large premium, for the same thing that they could buy somewhere else for much, much cheaper, simply out of convenience. Now, sometimes that's very much worth it because our time is also valuable. So sometimes we're paying for convenience to effectively buy back our time. Because let's say I'm making a recipe and I need 1 stick of butter and I don't have that stick of butter. Now, in the old days, we'd walk next door and ask the neighbor for a stick of butter. I used to walk next door and ask the neighbors for stuff all the time because my mother would send me. And that was the neighborly thing to do. We'd loan each other a cup of flour or a cup of sugar because the time it took to run to the store just to get a cup of flour or a cup of sugar, well, you could also spend more in gas. So sometimes going to the convenience store, you can save more in gas than it would cost you to drive to a grocery store. And for some people, they literally have to walk to places, and this is all that's available to them. There are food deserts in this country where the only thing around is a dollar store or a Dollar General, where there's not a grocery store within a walkable area. So sometimes convenience stores aren't really truly of convenience, but in many senses they are. And regardless of what you're buying in the convenience store, whether it's a bottle of water, a bottle of soda, a pack of cigarettes, a bag of chips, I think that's pretty much everything they sell at a convenience store, or some terrible food that you probably don't want to actually eat. But sometimes you do eat because it's convenient and you're hungry. So those things, they sell at a much higher price because of convenience. So normally we're buying it off of convenience and we're willing to pay that premium for convenience. Well, oftentimes this is what gets us hurt when it comes to interest, because we want things to be convenient and we're buying them in a way that's convenient for us, which is basically when we want them. So let's say you have about $100 extra each month, but you want to buy a television. So you have two options. You can save your money, and let's say the television costs $1,000. So you can save your money for 10 months. When you have the money to do it, go buy the television. Or you can go buy the television today on the credit card that they just sent you and pay that back over, in your mind, the same 10 months. But that's not really how it's going to work, because the interest rate they're going to charge you, let's just say it's 20%, so we can do easy math. Now, if you do the easy math on that, you would say, okay, well, $1,000 at 20%, and it's basically going to take me a year, so it's going to cost me an extra $200. Probably at least that amount. So, A, this assumes that every month you make that payment. So every month you pay that $100 you have left over. What happens when something else happens? What happens when you want now a microwave? Or you want a DVD player? Or you want an Apple TV to go along with your television, because the television by itself isn't good enough. Now you need a stereo system to go with the television. And you have credit, so why not just go use the credit card and I can get everything that I want right now, quickly and easily with my credit card. And I'll just pay it back later. Well, compounding interest means that, interest alone means that it's going to cost you a lot more. Compounding interest means that it may cost you way, way, way more than you intended. So let's say in this scenario, we've got a 20% interest rate and you're borrowing $1,000. So in your mind, the annual compounding interest is $200. But here's the thing, credit cards don't charge interest annually, they charge you interest every month. And what that means, and this is the how often does the rate compound? Is it daily or monthly or weekly or yearly? So if it's yearly, then it's a simple. 1,000 times 20% is $200. But if it's monthly, well, we're going to charge you interest on the amount that you owe that month. And let's just say you made no payments and saved up all your money and paid it off all at once at the end. Then instead of paying $1,200 as you would expect, you're actually going to end up paying $1,220 because the interest on the interest also creeps up on you. So your real interest rate isn't 20%. Your real interest rate turns out to be almost 22%. And this is how they play with you with the little asterisks and little cross signs of read the fine print that's set in your program or set in your documents that they send you. It's because they're not charging you an annual interest rate. That's how they show it to you in an annual interest rate. But they're not charging you interest annually. They're charging you interest monthly. Sometimes they're doing it daily. Now, what happens if you miss a payment? What happens if it goes, if all of a sudden you don't have enough 1 month to make that payment? They can charge you late fees. They can increase your interest rates. So the TV that should cost you $1,000 is going to cost you at least $1,200, probably more like $1,220. But what happens if something else happens? If some emergency comes up in your life that you need to deal with, that you have to go pay for, well, then you miss a payment on this. So as a general philosophy, what I tell people is the same thing my parents told me. Don't buy anything that you can't afford to pay for right now. But of course, that makes sense for most common purchases of things that you want. But that might not necessarily make sense, and it certainly doesn't when you come to buying bigger ticket items, houses and cars, and education. So understanding compounding interest is very important because, especially if you're going to college, well, do you have money to pay the interest? You don't, because you're continuing to get more loans. So that means that the interest on the interest is also growing and will continue to do so while you're in school, unless you get subsidized loans, which that's what the subsidized loan means. The subsidized loan means that while you're in school, the government's going to pay the interest on that loan. So the interest only starts accruing and you only start paying interest after. That's what a subsidized loan usually means. And there's a maximum amount of subsidized loans you can actually get. So compounding interest is really about the interest on the interest, and that the original amount continues to collect additional interest as well. So let's say I'm the one that loaned you the $1,000. So let's flip the script. We've talked about it in terms of, well, if you have to repay it, how much is it going to cost you? If I'm the one loaning it to you, how much am I going to make? And this is the position that long term we all want to be in. We all want to be the ones making the loans, not receiving the loans. Now you're participating in capital and you're generating revenue streams for you. With the long-term goal of it being, I don't necessarily have to show up to work anymore because my money is working for me. This is what they talk about, your money working for you. Your money working for you is your money paying you interest. Okay, so if I'm the one loaning you the money, now if I can charge you 20% and I loan you $1,000 and I'm going to charge you interest every month, but I don't require you repay it until the end of the year, I show you a 20% interest rate, I'm really collecting basically a 22% interest rate. And this is shown very easily in the example. And I have a worksheet that you guys can pull off the podcast, but you can basically just do it. The very simple thing is if I compound that interest monthly, then there's an interest expense every month. So if I loan it to you January 1st, at the end of January, there's $16.67 of interest for 1 month. And the way that you calculate that very simply is you say, I have $1,000 of a loan balance. I have a 20% interest rate. And then that 20% interest rate, you can either do it simple and divide by 12 for the month, or you can do it by number of days in a month. So when you get to how does a bank calculate interest, it's literally by the number of days in a month. So your February interest bill is less than your January interest bill because there's only 28 days in February. Except for that leap year, going to cost you more in interest that year because there's an extra day. One more day. So in theory, if you wanted to do it by the day, it would be 1/365th of 20%. So you would take the amount that you owe, the $1,000, times 20%, times 1 divided by 365. That's the daily amount of interest. But here's the thing. At the end of January, I say, okay, there's $16.67 of interest. So now the loan balance isn't $1,000. Now the loan balance is $1,016.67. So now I'm going to take the 20% on that for the month of February. And if I'm just using 1/12, then I get another $16.94 in February, and $17.23 in March, and $17.51 in April, and $17.81 in May, and $18.10 in June, and $18.40 in July. And by the time I get to December, it's $19.99 per month instead of $16 that it was at the beginning of the year. Compounding interest means that as the balance grows, every month it's more interest. That's the interest on the interest already made. That's profits on profits. If you reinvest the profit when it's given to you, then that gets to make more money as well. Interest is your profit if you're the capitalist. That's what you get back. So this is the way that the money system works in terms of money making money. And it works for you if you're the investor, but it works just as much against you if you're the one borrowing. And you need to know this because you need to know that every amount that you borrow continues to collect interest on it all the way along until you pay it back. So if you're a student and your parents own a home, I want you to sit down with your parents and go over the amortization schedule that your parents have on their house. An amortization schedule is a schedule that shows the amount of money borrowed, the interest rate, how much interest is being paid each period with each payment. So if you have a 30-year mortgage, the amortization schedule is going to say, based on the interest rate that you have, the amount of your mortgage, here's your monthly payment. Here's the amount of your monthly payment that goes to interest. Here's the amount of your monthly payment that goes to principal. On a 30-year mortgage, I want you to scroll down and look at the totals of that. And for most people on a 30-year mortgage, they are going to pay more in interest than they will for the house. Now, as I said, this works for you and against you. So instead of buying the house, you're investing in stocks. Over 30 years, you should have more than doubled your money that you put into the market. Excuse me. But if you're the one paying, then you need to see this and you need to realize that, hey, I'm going to spend more on interest than I am on the purchase price of my house. Which means the bank is getting more money than I'm getting in-house. Good for the bank. And we'll get into this in greater detail later about how one extra payment per year can reduce a 30-year mortgage to an 18 or 15-year mortgage, depending on when you make that payment, depending on what your interest rate is. But years and years of interest can come off from an extra payment. In the same way, it goes against you if you're the one borrowing money. And this is very important as we move forward and we start talking about student loan debt and credit card debt. These are concepts that it's extremely important that you understand this for your own financial future so that you're not the one paying for forever. You need to understand that there is a cost of money. That pretty much if you're going to repay your loans over a long period, you're going to end up paying as much or more in interest than you borrow. So if you're going to go borrow $100,000 of student loan debt, you're going to have to repay $100,000 of the debt. You're going to pay back probably close to $100,000 of interest. And then because you have to earn money first and pay taxes, the amount of money you actually have to earn to repay debt is typically 3 times the amount that you borrowed, especially over a long-term period. So that's massive. If you consider that what you're paying for every dollar you get of finance for your college student loans, every dollar you borrow costs you 3 to repay. That's a significant difference than thinking, oh, I borrowed $1, I need to earn $1. No, for every dollar you borrow, you need to earn 3. That's a lot more dollars. And that's the frame of reference that everyone needs to have when we start talking about the real impact of debt. If you don't understand compounding interest, then you don't understand how the system's working against you, basically. This is the fundamental concept of how the system works against you. They only talk about compounding interest in finance in terms of how it works for you. For your retirement plan, invest your money. Compounding interest means you make a lot more. The sooner you can put away money, the sooner you start making money. Compounding interest over 30 years is more than 20 years. That's the context that we all get it in, not the context of, oh, hey, you're borrowing money. How much is that really costing you to repay? But that's a very important thing we need to know. Compounding interest matters a lot, especially if you're getting student loan debts that aren't subsidized. So that means as a freshman, if you borrow $10,000, even if you've got a very low interest rate, let's say it's at 6%, by the time you graduate from college, after your freshman year, that $10,000 you borrowed is turned into $10,600. By the end of your second year, that $10,000 you borrowed is $11,271. It didn't copy for me. Sorry. 1 second while I continue this. At the end of the third year, it's $12,000. And by the time you actually graduate, the $10,000 you borrowed, you owe $12,000 on now. And that just keeps increasing until you start making the payments and paying it down. But the interest keeps running on and on and on every month. More interest, more interest, more interest. Same thing if you borrow money to buy pretty much anything, especially if you don't have money to repay it already, or a job where you're generating money to repay it. And this working against you is what keeps you in economic slavery. This is the magic sauce that they don't want you to talk about, and they don't teach you in school for a reason, because this is how they keep you paying. If they explain to everybody why it's going to cost you so much, then people would take out a lot less debt. But people think, oh, if I borrow $1,000, I have to repay $1,000. If I borrow $10,000, I have to repay $10,000. Oh, wait, I can't afford to pay it back this year. I'm going to pay it back over a couple of years. Oh, wait, now I had an emergency. And pretty soon, the amount that you have to pay just in interest every month is more than you have in disposable income. Which basically means you're paying them interest only, which means you're going to owe them that money forever, which means you're going to be working for them for forever. And they know this, and that's exactly the place that they want you to end up in. They want you to end up in dead broke. And what dead broke means is not that you're not making any money. That can be. That's literally broke. But if you owe, it just means you owe so much, you can't even afford to pay the interest payment every month. Well, if you can't afford to pay the interest, how are you supposed to pay down the principal? And the principal is the base amount of the loan before interest. And this is how a lot of Americans get trapped. This is the trap I see people falling into all the time with credit card debt. And buying usually used to buy a whole bunch of things that they could pretty much do without. Most debt is not even convenience spending. It's I want today. But you need to realize that what I want today, to get the simplest, easiest, fastest thing I want today for self-gratification, is going to cost you the most over the long term. It's going to be the same thing with going to school. If you want to go out of state and you're going to pay out of state tuition instead of taking a gap year and getting in-state tuition, it's going to cost you a lot more money. And that money, then you have to borrow for. That's going to cost you more money. And you're going to owe money. You're going to owe what you borrowed. You're going to go the interest on it. You're going to have to pay taxes with money you earn first. So $1 borrowed is not $1. $1 borrowed is $3 to repay typically. Because you got to earn $1 and pay Uncle Sam $1. You want to borrow $1, you got to earn back $3. The $3 you earn, one of them's going to Uncle Sam, one of them's paying the interest, and one of them pays back what you actually borrowed. So I want everyone to think about borrowing of a 3x concept. Every time I'm borrowing 3 times more than I think I am. And while that's not 100% true, it's a nice general rule to put in your head about how much debt you're really wanting to take on if you know that it's going to cost you 3 times more to earn that, 3 times in earnings to pay it back. And this is the part where people get really lost in the math, and it becomes really overwhelming quickly. So hopefully that lesson sticks. And we're going to come back to compounding interest a lot because it's an important topic. But let's move on to a couple of other terms that we need to discuss that go along with compounding interest. And the first one is purchasing. So with the exception of student loans, where we obviously understand, well, we sort of understand what we're purchasing, and we're going to get into that in more detail later. Maybe what you're just purchasing is food and housing, and not actually the education. That's half the education budget. So really, let's talk about it from a credit card perspective of just purchasing. So we're buying things. So we have a few different, like most people, I don't have to explain what purchasing is. You buy something, right? Well, let's talk about the types of things that we buy. So typically we're either buying, I'm going to call it food and shelter, basic necessity needs, right? or we're buying items of personal use and want. We're buying experiences, right? Or we could be buying investments. And let's define what an investment is and what an investment is not. An investment is something that is going to pay you, or has the high likelihood of paying you future sums of money. So if you buy an apartment and you rent it, then the tenants will pay you rent, and you own the building. You have something you can A, sell, and something B, that's generating money for you. Many, 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 many things are marketed as investments. These are not investments. I see it at the yoga studio all the time. Oh, workshop with, put the name of the famous person here, investment $40. That's not an investment. That is a cost. I show up to the class. I take the class. If I receive personal benefit from that, so be it. But if you can't measure that in monetary terms, then it's not by definition an investment, because it's not going to give me back any money. They market it that way to try and sell you more shit. Oh, well, I'm paying for it, but it's not really a cost. It's an investment. No, it's not. It's the same thing with coupons. You saved 30%. No, you didn't. If it cost $100 and you saved 30%, you did not save $30. You spent $70. That's not an investment. It's not a savings. You still spent money. Saving money means that you did not spend the money, that instead you bought an investment, and that is going to pay you money. And again, intentionally, they've messed with all of these words. The marketers have taken them and destroyed them intentionally so that they're not in your head. Every time I see one of these signs, and I don't care what it's for, I see lots of them all over the place. Ads in magazines. You're investing in your future. Donald Trump University. It's an investment in real estate education for your future. Now bankrupt, sued by students for providing no value, not an investment. And we're going to take that into college education. We're going to go, okay, what is the investment in college education? What amount of the education is going to derive you future benefit and earnings? And what are you paying for that? And at some point, if you pay a certain amount, it's no longer going to be an investment. What it is going to be is you sacrificing your future. So an investment is something that is going to give you back money year after year after year. So college education could be an investment because you're going to, in theory, make more money than you would if you didn't have that degree every year. But if you're required to take that extra money that you make and give it to somebody else, how many years of giving them that extra money is it worthwhile before that's no longer an investment and you're just working for somebody else? So when we talk about spending, what we're really doing is we're giving someone else money for goods or services. When we're investing, we're giving somebody else money that they're either A, going to repay us with an interest rate, or we're buying something that has a value, and that value in, let's say you're buying a stock, and you buy Apple stock. When you bought Apple stock, what have you bought? You bought, realistically, one simple thing: a right to the future cash flows derived from the Apple company's business. That's what you're basically purchasing when you purchase a company stock, a right to future cash flow. Now, in theory, you also get a vote. You own a share of a publicly traded company. You have one vote out of the tens of millions of votes for all the different shares outstanding. And you can vote on the board of directors for that company. The board of directors then decides who's going to manage the company, and the board of directors can hire and fire management at their will. And typically, the board of directors' job is to decide the direction of the company and then to hire the people to take the company towards that direction. As a shareholder of that company, you have the right to vote for the board of directors, and you have the right to receive the value of the earnings. Some companies will pay it out in dividends, which is really what you're buying long term. Other companies are reinvesting that money. Now, Apple's doing a bit of both, but they're now paying a dividend. So when you buy Apple stock, you believe you're going to get that dividend. But you can only get the dividend if the company keeps making money. If the company stops making money, well, they can't pay a dividend because they don't have money to pay it. Just ask General Electric. Used to have a really nice dividend, just cut it down to the absolute minimum just to say that they have one. But that's because you have to make money to pay that money out to shareholders. So this is what you're buying when you buy an investment, a right to a future earning stream. Now, when you loan somebody money, you're effectively buying an investment. You're buying the debt of that person, and they have to repay you that money with interest. But investments, in general, you're purchasing because they're going to increase in value and give you a future economic increase in money. So all the rest of the stuff that they sell you as an investment is not an investment unless it's going to give you back money by itself. Otherwise, you're paying for something else. Like, just because you get an education does not guarantee that you're going to earn more money. On average, that's what it says. But it doesn't mean you're going to be good at your job just because you have a piece of paper that says you graduated from a university. And depending on what you got your degree in, it may not be of great value in the world, and you may never make any money from it. Now, the theory is that you've learned how to learn so you can learn other things, and that will make you more valuable. Maybe. Maybe not. There are plenty of broke, not really functioning, able to provide real value in the world people who have gone to college and graduated. So there's no guarantee that your college education is an investment. You're going to think of it that way so that you can rationalize borrowing money or all the effort that you're going to put into it. What you're really doing is you're putting that money into yourself. You're betting on yourself that you will become an investment that does pay off for yourself. And your parents are making that gamble as well if they're going along for this ride and investing in you. It's not a real investment because they don't know for sure. They don't know the probability. The probability is not sure that you're going to make more. So, one other thing that I want to cover in today's podcast is sacrifice. And I want to start down this concept of sacrifice because sacrifice and investment and spending all tie very, very, very closely together. And here's exactly how. Sacrifice is saving today for your better tomorrow or your family's better tomorrow. So humans are the only species on the planet that are really can focus and concentrate and come up with a plan for the future. So you don't see monkeys that collect seeds breaking them open for more than today. They'll go collect food, break it open, eat it. They're satisfied today. They're not thinking about food. They're not thinking about storing food for the winter. All they think about is, let me get some food today, I got my food today, I'm good. Not thinking about, maybe we should build a little hut and fill that full of seeds, and then we could collect all of them today, and then tomorrow we could lay around and just eat some of them, and we'd have a bunch because we did work beforehand. So humans are the only species on this planet doing this. So therefore, we're also the only ones that have this ability to sacrifice. And parents do this all their time for their kids. So parents are saving money for their children, sacrificing for their children. Parents go to work every day to pay bills for their children. They sacrifice for the family. Investing is about choosing to not spend money today, but choose instead to invest money today. So I'm not going to get the new pair of pants today. Instead, I'm going to take that money and I'm going to put it away for my child's college education. I'm going to sacrifice having something today for something else better in the future. And this ties right in with compounding interest, because if you're willing to sacrifice today for a better tomorrow, compounding interest is the way that becomes a better tomorrow. It's the way that your money grows so that down the road you've got more of it. The reverse is also true. If you're willing to make no sacrifice, and if in fact you're even willing to do worse by yourself, make no sacrifice means you spend today what you earn today. But most people are going to go one further. Most people are going to do the opposite. They're going to spend more today than they made today. And then they're going to borrow. Which means instead of a better future, you're setting yourself up for a worse future. Because your future now also includes repaying the person who lent you the money so you could have a very nice today. A better than you earned today is what I'm going to call it. Or a more expensive than you earned today. So if you earned $500 today working, or $500 this week working, and you choose to spend all of that, you're at zero. Fine. You choose to save $100, you've sacrificed $100 worth of value that you could have received instantaneously right now for making more money on that money in the future. And think of it this way. Even if it takes 10 years for your money to double, then it's very simple. Instead of going out to dinner today, I'm going to wait 10 years and we're going to go out to dinner 2 nights instead. Because the money we don't spend today, if we invest that, then in 10 years we'll have twice as much. So either that, or we could go, if we just don't go out today, then in 10 years we can go out for free. Because our money's making the money. So then we don't even have to work to earn more money. And this is a very important concept going forward, because sacrifice is the way that we get ahead. And I'll say that you can sacrifice and get really ahead and become the capitalist. You can also just stay right in the middle and not get yourself in debt. But that usually doesn't work. Usually you're on one path or the other. You're either figured out a way to start saving money and you've continued down this road and process, or you haven't. And the problem is, if you haven't, most people who live paycheck to paycheck, which is most of America, by the way, according to the statistics, this stuff's fascinating to me because it just seems really, really crazy to me that this is the world we live in. So this article is from Forbes magazine. So this is a legitimate publication from November of 2018. Okay? America has a financial literacy problem, without a doubt. 44% of Americans don't have enough cash to cover $400 emergency. So what this means is that half of Americans have sacrificed absolutely nothing to save for their future. This is the importance of sacrifice. Most people not doing it. Right? Which means you're one little accident away from not being able to pay your bills because most people spend literally every single penny that they're given. Right? That's a huge statistic. That is crazy. The other statistic in here is 38% of households have credit card debt. That's 1 out of 3 people. And on average, they owe $16,000 at a 16.5% interest rate. Right? So they give you the math in here. They don't show it to you perfectly, but they basically say, if you took 10 years to pay off that balance, then you're going to pay more in interest over 10 years at 16% than you are in what you owe. But again, if you owe $16,000 and it's going to take you that long to pay it off, remember, I just told you, money's triple. So you got to earn $48,000. If you have $16,000 in credit card debt, you have to earn $48,000 of money you have no other purpose for except for to pay taxes, interest, and repay what you already bought. So that means that instead of Americans sacrificing, on average, this third of America has overspent. There's no sacrifice going on. In fact, we're all taking today and owing tomorrow. So if you want to become a capitalist, you have to be willing to sacrifice because you can't be owing tomorrow and be a capitalist. You owe. That means you're on the other side of that. You're the one the capitalist is lending money to. You're the one paying for the capitalist. So everyone that wants to get upset about capitalism and the capitalists and they control everybody, no, it's people making poor decisions, people not willing to make sacrifices. And that's not to say I don't have a lot of compassion for a lot of people who don't make a lot of money in this country. But there's another concept that's very important, and that's that wealth is relative. So if you only make $500 a month and you have $500 in savings, you have a month of expenses. And vice versa, if you make $1 million a year, but you spend $2 million a year, you're also not saving. And interestingly enough, in this same article, this woman speaks about major financial issue with, I work with young professionals who are making 6 figures but drowning in credit card debt. So this is not, I don't have enough money. This is, I don't understand what I'm doing with my money. I don't understand what sacrifice is. I don't understand what compounding interest means when it works against me. Right? She goes, I work with young professionals who make 6 figures but are drowning in credit card debt. I've also worked with clients who are earning a very modest salary, yet have a fully stocked emergency fund, are debt-free, and are investing for retirement and other goals. Sacrifice. It's possible. It's not about how much you make. It's about how much you spend. And it's about understanding that when you spend money you don't already have, the cost of repayment is going to be very high. Part of that's because we don't understand how this math works. We don't understand how compounding interest works. So hopefully this gives you some basics in how compounding interest works. Hopefully this podcast has explained to you how your money that you borrow costs you more. And I want you to keep that 3x in your head. It might not always be perfect. Sometimes it might be a lot less than that. But if your anticipation is that for every dollar that you borrow, you're going to have to earn 3, we're not going to be highly disappointed here very often. But that's the simple math I want to give you. And you can go into our college debt worksheets and see what compounding interest does against you if you have to pay. And then if you're missing payments, like a lot of people are, a lot of people can't afford their student loan payments because they're so big. Well, guess what? The interest doesn't stop. It keeps growing. And this is the same thing with your credit card. If you miss a credit card payment, it doesn't mean you don't owe that interest. No, now you're going to owe even more. And we're going to slap you with penalties. In the same context, when you borrow, they not only slap you with penalties, but, let's talk about what a loan origination fee is. A loan origination fee means that if you want to borrow $10,000 from me, you're going to have to give me back typically 1% to 2% immediately. So I'm going to loan you $10,000. I'm only going to give you $9,800. The other $200 is your upfront loan origination fee. And they're going to do this with student loan debts and everything else. And depending on what the debt is, there's a fee. Go buy a house. There's a loan origination fee. Cars are the one place there's usually not a loan origination fee, interestingly enough. And we'll get into cars specifically down the road. But today, hopefully, you learned about interest and compounding interest, and that it can work for you and against you. And that cost of money working against you means that what you pay for later, what you buy on credit today and pay for later, will cost you at least double. And you'll have to make 3 times what that amount is. Those are the things that I hope that you take away from today's podcast. I hope that you'll come back and continue this series. We've got a few more topics to get to on the basics so that you can understand. Now that you understand what an asset is, what a liability is, you understand interest, you understand inflation, you understand compounding interest. You can know what credit is at this point. You know what debts are. So, we've got to talk about a few more items of basics, and then you're really ready to take on some other additional concepts that are more complex that we can get into detail about specific transactions and how they occur. But most of these basic concepts are not difficult concepts, I don't believe, for everybody to understand. It just takes a little bit of time and frequency of being with them. But I promise you, these are going to be important things for you to understand for the rest of your life. So thanks for listening. This has been Keep Yours. Be back very shortly with another podcast.
Thanks for listening to the Keep Yours podcast. If you like what you've heard, head on over to iTunes to subscribe and leave us a review. This will help us reach more listeners, grow the show, and keep putting out more episodes like this one. Check out show notes and more resources at www.keepyours.org. See you next week.